Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. With major markets charting different paths to recovery, how might investors access what many are calling a K-shaped economy? Gordon and Chris Maludzinski are co-managers of Fidelity Global Small Cap Opportunities Fund. They both join us here in studio today to share an update on how these diverging market conditions are impacting their investing thesis. We're also going to dive into whether the interest rate environment is driving their portfolio or not. Where are these co-managers finding mispricing opportunities, both in North America and across the globe? Just to let you know that today's webcast is presented, of course, in English, but has live audio interpretation. So join us in either of our official languages. Welcome, Connor and Chris. Great to see you both. Thanks for joining us here today.
Yeah, thanks for having us.
And we'll ask everyone to send their questions in. You're joining Chris and Connor just the way I am, so send your questions in over the next little while. Let's begin with interest rates. When you hear small caps, it's often related to interest rates. To what extent is this a driving factor to the way you invest?
Yeah.
You want to start, Chris?
Yeah, sure. I'll start with that one. Yeah, I mean, when you think about small caps, you think about levered companies, profitable companies, the beta trade. If you think about global small caps, emerging markets also sensitive to interest rates. That's not really what we do and the way we look at things. We focus on high quality businesses, generally under levered businesses run by very strong management teams. But focusing on inflection points, which is part of our process, interest rates do factor into that, right? So we've talked about in the past a number of businesses that we've owned that benefit from an interest rate cycle on the upside. Now it seems that the joy is taken out of that, the air is coming out of that balloon, and we're probably going to see the cycle on the downside for interest rates. So a lot of the companies that got hurt from higher interest rates, we can go in, take a look at them. They're cyclically depressed, and they could have a tailwind coming out the other side. So that's where we're focusing on a lot of our time right now.
Okay, fantastic. Could you define inflection point for us, just so we know what we're talking about? So interest rates could be an inflection point. There's a lot of other ones.
Yeah, look, I think one of the things you asked in the previous question, like, are interest rates a driving factor in our investment process? And the answer is no. Our investment process, we define it as inflection point investing. So what does that mean? Ultimately, we're trying to invest in higher quality businesses that are undergoing an inflection point that allow us to underwrite higher earnings, higher multiples, and ultimately a higher stock price. So our inflection points, there can be generally three types of inflection points. There can be a structural inflection point, a cyclical inflection point, or an idiosyncratic inflection point. So if you think about structural inflection points, that can be changes in technology, changes in consumer behavior, changes in regulation or government policy, right? And cyclical, that can be changes in supply and demand inside of an industry. So maybe a company that's moving that has had cyclical headwinds that is kind of inflecting, and those headwinds are becoming tailwinds. And then the third one would be very idiosyncratic, very company specific. So think of situations where you might have, typically a company with a new product or a new management team, or they're restructuring or buying or selling a business. That's what we're looking for. And because we have this smorgasbord of the types of opportunities that we're looking for, our investment process doesn't tend to be driven by top-down factors or interest rates. Now, I think everyone has their eyes on a big structural inflection point that's happening in the world and in the market, right? Which is AI and all of its derivatives. That's not something that we necessarily had a lot of exposure to. This fund, Chris and I typically have had less than 5% technology exposure. I think where we have had exposure to AI has been on the more power side, more than on the industrial side of
like where you're plugging it into.
Exactly. Okay. Companies that are not necessarily utilities, but industrial businesses that are selling into utilities or selling into the energy companies or the materials companies that are potentially mining copper or some of the materials that are required for electrification.
That sounds like utilities.
Not utilities. Not industrial businesses, think of it like selling industrial widgets into these companies.
Okay.
What's happened, you mentioned in the intro, that K-shaped economy, right? It's artificial intelligence and everything else. And the artificial intelligence, to a large extent, has been, let's call it, crowding out some of the traditional sectors of the economy. So pressure on consumer wallets. We all go to the grocery store. We all see inflation and how that's affecting consumer wallets. On the industrial side, interest rates have stayed high for, I think, longer than people might have anticipated if we were sitting here a year or two ago. That is creating some cyclical headwinds on many of the industries that Chris and I tend to focus on.
Really
and that's where we're starting to find those unique opportunities in, interest rates, things related to housing or real estate, where maybe these cyclical headwinds are starting to become tailwinds.
Okay, really interesting. So where do tariffs fit in? They fit into not structural, cyclical. At one point we thought maybe they were idiosyncratic. Maybe they moved into the cyclical bucket. But your companies clearly would have had to deal with this on some level. I mean, global companies are dealing with this.
Definitely.
Chris, how has that just changed the way you've had to deal with things? You've had to go and scrub the numbers again.
Well, the good thing is, I mean, when we invest in a company, we look at the risk factors, the upside, the downside. And we want to make sure we build a ship that can weather any storm, right? So when I think of tariffs, and I think of the companies that are really hurt by tariffs, I think of maybe small companies that have a lot of leverage and no pricing power. Because if your margins get hit, you don't really have anywhere to go. Given that tariff example, and they have a lot of pricing power, well, they can increase those prices, maintain their margins, and actually come out better on the other side because they'll be able to take market share from some of the weaker players that might have to cede or might even have to go through restructuring themselves.
Really interesting. Take us to the fund itself and sort of how you manage it, the process. It's both of you, obviously, doing this at the same time. How do you kind of divide things up and work as a team ultimately? Put that to you, Connor.
Yeah, Chris, I think this fund, Chris and I, the reason the fund was created almost 6 years ago was, Chris and I brought a very, very similar investment style to the fund. But we had divergent paths to get there. So, if the Fidelity analyst system, I had covered industrials, technology, and healthcare. Chris, on the other hand, had covered consumer financials. When you put that, I guess, experience base together, the whole point was bring two people together, give them the biggest opportunity set, global, relatively concentrated, called 40 to 80 names, tends to run about 60 to 80 stocks. Best ideas from around the world, and with a high tracking error fund, and that was the idea, and that's kind of what we, I think, have delivered over almost 6 years on the strategy.
How big are these companies? So you mentioned they're small cap. Small cap can mean different things in different countries.
Yeah. The way we think about it is between 2 and 20 billion is kind of like where we're
big enough range.
Yeah, I mean it's moved up a lot over the past 5 years as well. Given the bull market, but I mean I guess in a Canadian context you might think of small cap as sub 2 billion, and that's kind of where we start to look at companies, and that's on a US dollar basis. If
they grow out of that range, do you make a move or?
No, I mean, thankfully, 30% of the fund can be above that range. And I guess what attracts us to the small cap asset class is that it doesn't suffer from the law of large numbers, and there's a lot of obviously mispriced opportunities because there's fewer eyeballs on these securities. So, there's one name in the fund that started the year at $6.5 billion. Today it's around $23 billion. You don't really get that opportunity in the mid cap and large cap sectors if you're looking at those. So. We're able to, if the thesis is still valid, the risk reward is still attractive, even though it's moved up, we're able to continue to hold it in the fund.
Yeah, I think maybe just to put a cap on that. So to be specific, so there's no sunset clause, I guess is what we're saying.
Yeah,
so,
okay.
As Chris said, if we buy a stock and it's a $5 billion market cap and suddenly it's above that, the top of the index, which is how we define it, we're not forced to sell it. Right. But in general, I would say that when we do sell it, that capital tends to get reinvested back at those smaller market caps, right? And I kind of, we always say, jokingly, our job is to find small caps that are on their way to becoming large caps. Large caps are success.
So you're there for a very defined but growth path for these companies, and that's what you're sort of playing in. Tell us a bit about where some of these companies are. It's global, get it? Is it global? Developed necessarily? Do you touch EM? Tell us a bit about that.
Yeah, I'd say, so have the ability to go anywhere, but our focus is really developed markets globally. Okay. So think of this as, if you're to put it into buckets, the world is split up roughly 50-60% in North America, so United States and Canada, 20-ish% in Europe, and then another 10 to 15, 20% in Asia Pacific. So in developed markets, that's primarily like Australia, Japan, Western Europe, North America. Historically, we have had a general overweight to the United States, Canada, and Europe. And we're global. I would say practically we have been more of a transatlantic fund than a true global fund. Primarily it just comes down to our ability to find ideas. We feel like we have more of an edge in markets where we're just closer to the market. So I would say we have selectively played in Japan, but I think the max that Japan has ever got to is maybe 4 or 5% of the fund. So it tends to be more core U.S. Europe, and then selectively pick off ideas in Asia Pacific, and then some select emerging markets around the world.
We've held like 2 or 3 names in emerging markets, I think, today. We do. So we're able to go there.
You
it's
can
just
go
not
there.
a core
Okay.
focus.
So it's interesting. There's a fiscal story that's going across the world, and that's been very much part of the there's many reasons for the international uptick this year. But your global fund, you caught that? Yeah.
The fiscal, well, I mean, we could talk about some of the
Fiscal maybe more now, but the
Yeah.
shift from January onwards has been this story.
I call it crossing the Rubicon, right?
Yeah.
And I think if you just go back to 2008, right, the world, post the GFC, basically the world has been awash in monetary policy,
for sure,
right? And I think what the period between call it 2008 and 2020 kind of taught everyone is that there's limited efficacy. And then we got into COVID, and what happened? We turned on the fiscal switch, and everyone realized, holy cow, if you want to create inflation, this is how you do it. And I think politicians in particular figured out that if you want to create outcomes and direct investment, you can do it through a fiscal lever rather than a monetary level. And I think where you've seen this really radically play out, and post-COVID, post Russia-Ukraine war, I think there's 3 large areas, and I think these are large structural inflection points that we have had exposure to. So the first one, and you can think of this as just broadly security. Yeah. So defense, energy security, supply chain security. So our exposure, we have historically had a significant exposure to European defense companies. So
historically, before the fiscal taps got turned on, just very recently on that.
Yeah, roughly 2023.
Okay.
It's not a large part of the fund anymore. We've moved on, but that inflection point was Ukraine. Was effectively Ukraine. Europe taking budgets from sub 1%. Right. And most recently at the most recent NATO summit, taking that to very significantly higher. And then you can think of like energy security, right? All of the investment, AI has really supercharged this, but even prior to AI, there were, Europe trying to insulate itself from Russian gas, the rest of the world trying to electrify, move away from, fossil fuels effectively, right? So that requires a significant amount of investment. And then the third one, which I think is, was catalyzed by COVID, but really has been, kicked into supercharge mode here with, some of the geopolitics that are at play, particularly with China controlling many of the world's critical supply chains. A lot of that needs to be reshored and re-domesticated. And you can think of, rare earths, I think, get all of the headline attention.
Yeah.
But there are other ones like, semiconductors, right? And you see like companies like TSMC, Intel that's successfully trying to bring some of that fab capacity back into the United States. The other one is, I think, is pharmaceutical capacity. So CDMO exposure, contract, development and manufacturing, actually manufacturing these drugs.
The pharmaceuticals, yeah.
Exactly, needs to be, and a lot of the ingredients that, the active ingredients that are used to produce these things need to be brought back into, Western Europe and the United States.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
So that's super interesting. Chris, tell us how, because some of the companies that you just named there, Intel, these are massive companies, and they're involved in exactly the shift you're talking about. How do you go at it as taking a look at smaller companies riding on some of these themes that are clearly playing out all around us right now? We're in the midst of this massive shift. What kind of smaller companies are you looking at that are dealing with these and actually creating some growth?
I mean, are you?
So like, I mean, one of the great things about small caps, small companies is if you are investing in like a Fortune 500 or S&P 100 type company, these are they're typically incredible businesses. You don't get to be one of the 500 biggest businesses in the world without being incredible at something.
They figured out a lot of the problems
exactly
at that point.
Exactly, but one of the things is that when you're oftentimes you're so successful, you get so global, you get so diversified that we often find some of the direct beneficiaries of these themes that we've been talking about tend to be in smaller companies, right?
Yep.
So we can actually, in many cases, get access and provide our fund holders with exposure to, direct exposure to these themes that we're talking about, investing in some of these, smaller businesses, those 2 to call it 10, $15 billion market cap companies that are, established, but have more idiosyncratic or growth profiles than you might get exposure to with some of the very, very large global diversified companies.
So, I mean, they are in the industries of perhaps defense, various logistics within supply chains. Like, take us through some of the types of companies that are in exactly those bigger themes. Maybe, Chris, you can begin with that.
Yeah, so I mean, I'm just looking at, if you think about over in Europe, right? Like a lot of the Europe, mid and large cap companies are global in nature, right? So if you look at, hopefully there's, peace in Ukraine, Russia, Ukraine, or there's going to be obviously rebuilding over there. So a lot of the materials companies, the smaller materials companies are direct beneficiaries of that, right? So think about infrastructure spending, building
the
materials,
story,
the cement
right?
story, stuff like that, right?
Building materials.
Those are kind of pure play, or even the financials companies, Eastern European financials companies, for example, direct beneficiaries of that as well, right? So that's kind of what we're looking to do is just like isolate where the investment tailwinds are, and then go find the companies that are direct plays on that, rather than have 10 to 15% of their business with exposure to that, and then you get a big U.S. story as well. So
when we look at some of the top 10 and where they are globally. Not tons of Canada, it doesn't look like. Tell us a little bit where Canada fits into this story. Maybe it doesn't. I'm not sure if it does. But do you look to it ultimately for some of these idiosyncratic or cyclical or even structural stories that you talk about?
I mean, we look.
We look.
We look. It's a little harder, right? And I think one of the hard things about when we have, people will often look at our fund, look at our exposure, and say country exposure. You have a large overweight in Canada. You must love Canada. We have a large overweight in Italy, like what's going on in Italy.
Yeah.
And it tends to be, we're not looking at the domestic market necessarily. We kind of look across, we divide the world into sectors rather than geographies.
Okay.
And we're trying to find, those best of breed companies in specific sectors, regardless of where they happen to be headquartered. So we pay more attention to the revenue, the actual revenue and profitability breakdown and where that's located, rather than where the headquarters happens to be.
Sure.
Now that that is it's a risk. It's a risk that needs to be monitored when you are managing a global fund, because you do have to pay attention, particularly when there are there's currency volatility, right? And that's been one of the big themes this year in global markets has been the dollar is down. Right.
Do you hedge for that? How do you work with that?
We do not hedge. There is a we offer the fund is offered in a U.S. dollar version, which gets you 60% of the way there.
Yep.
But I think in general, what we're over time, our view is that we're not really playing in these emerging markets where you're going to wake up and there's going to be a currency depreciation of 20, 30, 50%. So we're in developed markets. It creates short-term volatility, but if currency is a make or break in an investment thesis, we're probably just not going to be.
Another thing is just tax as well, right? With all this fiscal spending, a lot of governments are a little overburdened and may look to change tax policy. So that's a risk that we're always monitoring, because corporate taxes could go up in certain jurisdictions. So we got to make sure that we're not too over exposed there. Yeah.
So fascinating. Within sort of the discussion of interest rates, but financials primarily, where you've taken a look for, I think, years, and also real estate, there's always another opportunity within financials. I mean, insurers do well in certain types of interest rate environments, and of course, banks do well in others. Tell us
Yeah.
what's of interest within the financial
Right now, actually, regional banks in the U.S. I mean, generally, we've shied away. Really had no exposure there. But now, there's this consolidation, theme and wave that's really picking up.
Can you invest into that, or do you just steer clear?
We can invest into that because, I mean, if you just look at where these companies are trading, the last time we had a big consolidation wave was pre-GFC. So we're looking back to like the 04 to 07 timeframe. And all these companies were trading at 3.5 times tangible book value. Today they're 1.5 to 2. So if you do see that pick up, and banks look to get further scale, well then that's just like a kind of a rising tide lifts all boats scenario. So we can look for potential mispricings, idiosyncratic opportunities. Certain banks are more attractive as takeovers. So we can kind of look to surface value there right now. So. We talked about insurance over the past, 3 years having, the big tailwinds behind it. Today the insurance market is changing. Premium increases are, flattening out. They were going up by, 30%, 35% over the past number of years, right? So that's kind of tapering off. Interest rates are on their way down. They benefited from both of those. So, you got to kind of go and have to look for, other tailwinds in other, parts of the market and financials. So that's kind of where we're spending our time. Real estate companies is another area that we're spending a little bit more time.
In Canada,
REITs, for example, globally. Thematically, spending a lot of time in retail real estate in particular, because if you go back over the last decade, from 15 to 19, it was all about e-commerce. So a lot of the retailers were building out their e-commerce operations. Industrial REITs really benefited from that, really all the way through COVID. And then 2021 or two, that peaked, and so they're on their way down. And now all retailers are focused on omni-channel, so really high quality bricks and mortar real estate as well as to complement their e-commerce offering. But what attracts us is there's been zero new supply in retail. And that's what kills all real estate cycles. So, there's been inflation. A lot of the national tenants are expanding. A lot of demand, no new supply. That's really good for, obviously, your cash flows and your top line going forward.
That's fantastic. There's some great questions coming in. So let's some very fund specific. So you can go for it. Can investors access the investments through segregated funds, end of fund, death guarantees? I mean, these are very specific things that maybe someone else is better to answer. But
I think someone on our product team should answer
should take that one.
Yeah, look, the fund's offered in obviously a mutual fund for retail investors is offered by a mutual fund as well as an ETF.
So lots of questions about allocation. I think you've gone through that. Do you want to just sort of actually chunk it out in terms of allocation, geographic allocation? That's the question.
Yeah, I think in general, you should expect the fund, plus or minus to be, 50, 60-ish% in North America. Okay. And then like 20 to 30% in, Europe and, infill in, Japan and maybe some very, very, very select emerging markets. But think of us as, more of a transatlantic fund than a, pure global fund that is going into every geography, top down, having exposure to every single geography. We want to be, we want to have it's a relatively concentrated fund. And so when we're doing that, we want to have high conviction in all of our, and build conviction in all of the individual holdings. So we don't want to be beholden to having a top-down asset or country allocation, for example.
Give us a wild story that's a little bit, that is idiosyncratic.
Well, we're always on the lookout for, one of the things is, everyone's on the headlines, but, we often don't talk about, we have 140 analysts around the world that are doing the bottom of fundamentals. So one of the things that we like to do, particularly when there are, when there's more uncertainty or more volatility in the market, is really try and take advantage of more of the idiosyncratic opportunities. So that's
a
really
one-off change of something,
special situation that's little less tied to the overall market. So one that popped into our top 10 that you'll see now is a company called Dollar Tree. And Dollar Tree, everyone in Canada is familiar with Dollarama. Mm-hmm. Dollar Tree is a dollar store in the United States, and they have had a almost decade-long period of underperformance. And one of the reasons, the primary reason, is that they back in 2015, acquired another concept called Family Dollar. And Family Dollar has been a drag on performance for a decade. they announced earlier back in the spring that finally they had found a buyer. And so effectively what happened? Inflection points, idiosyncratic inflection point. They are restructuring, and they're going to basically cut out the cancer out of this gem that you have. Dollar Tree concept, extremely good. High return on capital, unit economics with a runway for growth. Some very interesting things in that they're doing strategically to take their price points from $1, going to multi-price point, right? So organically, but it was continually being dragged down. So all of a sudden, you're cutting this company out, and you're left with the pure gem. Those are the types of things from an idiosyncratic perspective that tends to get us excited, and tends to hopefully have a big chunk of the fund where the performance of the business, the performance of the stock is less dependent on macro factors and can really be driven bottom up.
Yeah, and like a company like Dollar Tree, we have a roadmap for that because Dollarama did the multi-price point. They executed on that opportunity over the last 15 years. So the management team at Dollar Tree is coming up here, taking a bunch of learnings from what happened in Canada. It's a little bit more competitive down in the U.S., so it's going to be a little bit tougher to execute to the degree that Dollarama has. But you just know that when you increase prices, you see a little bit of volumes, but it's really good for the top line and the margins of the company.
Fantastic. So they spun themselves off in a way. They kind of did that.
Yeah, they divested and they basically got it off their books.
So as sort of a final point to leave investors with, what do you want them to know about this fund in terms of how it may complement what they're already invested in? Lots of investors are actually invested in the Mag 7 in some way, for instance, or they have that exposure. What do you want them to know about their fund? Chris, we'll begin with you, give you each sort of...
Yeah, no, I think it's, again, we've kind of hammered this home over the last few years, but it's a good complement to where a lot of investors are positioned today. A lot of US, a lot of technology, very little technology in the fund, focus on, different business models, overlooked business models, business models that are out of favor, to really give investors a good complement to what their core holdings are today.
Yeah, I think that we're always trying to expand our client opportunity set. So I think if you're primarily in an S&P 500 fund, you're 70-80% of that market of your exposure is actually in the top S&P 100, right? So you're taking a very concentrated bet on a small number of companies, and we want to expand that opportunity set. There are a lot of great opportunities out there in smaller companies and companies that are located outside of North America that many client portfolios typically don't have exposure to. So expand the opportunity set, diversify, right? As Chris said, I think we tend to give you a bit of that diversification outside of North America.
So mostly industrials. Take us through the three core sectors.
Consumer, industrials, financial services. This tends to be the core of what we do and the core of where we have generated the bulk of our performance.
And just briefly, is now a perfect time to invest versus a few months ago because of the interest rates? We'll just top and tail this the same way we began. Is it astonishingly a better moment because interest rates we think are going down in the United States, for instance?
My personal perspective, it's always unclear. Obviously valuations have moved up a lot over the past few years. There's a lot of anticipation, obviously, of a cutting, cycle here. Is the Fed going to cut, more than we think? Or are they going to be a little bit slower? How's the economy going to do? So it's really impossible to know in real time. But the good thing is, it's an evergreen asset class. There's always mispriced opportunities. So in our view, it's always a good time to invest.
Fantastic. Connor and Chris, thank you very much for joining us here today.
Thanks for having us. Thanks.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.